All right, so we're recording. So hey everybody, this is Stu and David, and we got Mark David, one of our preferred lenders in Milwaukee for our turnkey properties with Storehouse. And Mark reached out to us just a little bit ago and just kind of give us some updates on just the lending environment. And so we thought we would just have him on and just kind of keep us updated on what's going on, just with reference to COVID and how the lending has changed, if any. And just wanted to keep everybody updated on kind of the current environment of things. We're obviously still buying houses and selling houses, and Mark is still lending and helping our investors get stuff done. But I think and Mark can help us with this. But I'm assuming stuff is tightened a little bit. So Mark, over to you, man. I guess first.
And real quick, one aside, jump in. Mark, one thing that that we from Storehouse have absolutely valued with you and just our interactions is you're a very creative individual. You find ways to get deals done and to finance. So for anybody that does see this video, I would recommend, at a minimum, if you're thinking about lending, you're thinking about moving forward with things, we always recommend that you give Mark a call, because you will absolutely learn something, and I do every time that we speak as well. So appreciate it, Mark.
Yeah, well, I definitely enjoy kind of taking some time here today to give you guys a little market update on a variety of different topics, which change, I swear, it's almost like daily these days. But really, we're sitting here right now, mid-May 2020. And did we think things would be this way? If we would have looked back, even like we go back 60 days ago, is what I just kind of want to roll back the clock on for explaining kind of what has been changing and why and where things got to be where they are. But ultimately, when people started, as the COVID-19 became a more pivotal piece of our economy and in the overall world economy, it started trickling into some very Main Street type of pieces of what we're dealing with. But on a larger scale, we started seeing the stock markets, having major sell-offs. We started then seeing, because of that, also in the bond market, major changes were happening. These institutional investors were pulling out of the bond markets. And the bond markets, if you guys are not familiar, that's really a big piece in most of the financing backstops that get used for the money that we use for, in this case, on these 1 to 4 family investment property loans that we do. So the mortgage-backed securities market, essentially the main investors that were investing in there, they started kind of looking at the whole big picture, and they said, well, wait a second, we don't want to play this game anymore. So we had everybody pulling out of, not everybody, but a lot, massive chunks of money were getting pulled out of mortgage-backed securities, out of the regular, Dow and the S&P. And if we go back to the week of, I think it was that second or third week of March is when things really started getting, unfortunately, all too real on what the future could have really been and where we could really be standing today. But in a nutshell, we saw one of the most volatile weeks in the mortgage-backed securities market. In the course of 1 week, we were seeing rates jumping, like 6-7 times a day, or, whereas normally when we issue rates in the secondary market, they maybe get changed. Usually the rates are issued on a daily basis. Let's just put it that way. And once in a while, we'll have 2 times in 1 day, we'll have a change. Well, during the course of that week in that part of late March, we saw, like I said, 6, 7, 8 times in 1 day, rates were changing. And what was really happening behind the scenes was these large chunks of money of institutional investors were basically saying, hey, we're done playing this game. And we were seeing rates that could have been 3%, went from 3% in the morning to 5% by the evening, which is in the indexing of how all of the stuff is laid out. That's a really very turbulent time from our standpoint. So thankfully, the Fed did that following like Sunday. They introduced and implemented, in essence, a support line for the overall mortgage-backed securities markets, where they committed to dumping billions and billions of dollars into the mortgage-backed securities market on a daily basis, to pretty much flatten that out, to get it more stabilized to the way that it should be. And at this point, they've committed now to say, hey, we are going to keep doing this until we see some recovery happening in the overall consumer spending and, job claims, which we'll talk about that in a minute too, that impacted all this as well. But essentially, if the government wouldn't have been stepping in to do this massive injection of money that they're doing right now, which right now is a major, major help for all of us, our investors, our, regular primary resident, single family home, owners, that type of thing. If this injection of money wouldn't have happened, we would literally today be sitting in ranges of like probably, 7, 8, 9% interest rates, and property values probably would have plummeted like almost overnight, like 20%. So the key thing to kind of take away from what I just said, though, is there is a stabilization that's currently in place, which is a very good thing. We need the housing market, whether it's investment properties, to provide rentals to individuals that way for housing, or for housing as primary properties. We need that. That's a huge cornerstone in our economy, and so it is stabilized. But what came as a kind of reactionary measure to all this is the CARES Act was getting rolled out around that same time too. And a big part of the CARES Act is this commitment to help homeowners with regards to, if they can't make their payment, they can go into what's called a mortgage forbearance, in some cases up to 6 months out. So as soon as we had things stabilized in the mortgage-backed securities markets and we're thinking, hey, we're smooth sailing, everything's going great, all of a sudden there's this huge onset of the ability to have people essentially not make a mortgage payment for 6 months straight. And sounds good, you're like, okay, these people are going to get to be helped, fantastic. However, in the past, when we had different forbearance or payment deferment plans that have been put out by the government, there was some type of documentation needed or proof that you really had to need for that type of help. And in this particular case, the difference is there's no strings attached, no documentation needed. So it's right now a current problem that the mortgage and lending and finance industry is still yet dealing with as it's getting unfolded. But at the moment, somebody can call up and talk to their mortgage servicer and say, hey, what's this forbearance thing for, not making my payments? And it's a click of a button and they're enrolled into that program. Sounds great, but it's a massive problem to the entire financing system, because now money's not coming in to that servicer, but yet that servicer still has to be paying the bond holders that are those institutional investors that are actually really making the whole flow of money happen. And there are, again, certain tweaks that the government is still working on with regards to that. But that's then what next was our big challenge that we've been dealing with in the last 45 days is because of this forbearance issue, the mortgage servicers, the banks, and the lenders then came up and said, wait a second, this is going to create this massive liquidity issue. And a liquidity issue is, let's say, ABC mortgage servicer is, let's say they're servicing $100 billion worth of mortgage loan notes. And under the current numbers that we're seeing right now, it could be like 20 to 25% of their loans that they're servicing might sign up for this forbearance plan. And that means, again, if it's $100 billion of mortgage loan notes that servicer is doing, and now you have 25 billion that they're not receiving interest payments on. They're worried they're going to burn through money like lightning fast, and they will be. So what a lot of the servicers and the different banks within the entire system have decided to do is, okay, how can we change up our lending options to weed out the people that might have more of an issue with that type of a forbearance plan coming through. So a lot of banks, a lot of lenders, almost overnight cut off entire, portfolios of program options is what took place. And with regards to why that's important, we're talking, we went from, overnight, these places that people could get access to money very easily were just overnight gone. And that probably has hit hardest, again, with the various high risk sectors, which usually are going to be people maybe with like not as high of credit scores, have been impacted by that. Commercial lending is being majorly impacted by this too, which we can talk about that in a minute as well. But also investment property loans are a category that there has been some tightening in as well. Now, I can say, fortunately, our parent company, who I'm part of, which we're a national company, CMG, we've taken a different stand on this whole topic. Thankfully, we're liquidity-wise and financially positioned very, very well. So we've always been balancing our servicing portfolio properly, which some and many lenders did not. So I'm pretty proud to say we really haven't needed to change our menu of options a whole lot. The types of credit scores that we're still helping pretty much the whole entire spectrum of people, which is, really important right now. And you guys know, I mean, I'm big on serving people. That's we very rarely talk about like how many loans we did. It's how many families we served or how many investors we helped to make a difference in their life to help others. So that's our big thing with this is, yes, there's a lot of changes happening, but we've been overall able to not really change things up drastically. The regards to like things that though have changed is they are looking things over a little bit closer when it comes to underwriting a loan. The normal procedures and things of that nature, it is getting a lot more centered around, is this person that we're helping still working? Because again, right now we're sitting at potential unemployment rates temporarily that we might hit, could hit, 15, 20%. And that's pretty huge, obviously. One out of 5 people might not have the same type of income stream coming in. So that part of the process is being reviewed differently. We're, asking for more updated pay stubs. We're having to call their employer or whoever, provides them money. We're having to do extra check-ins on that during the process. They are also, in some cases, changing the underwriting algorithms and parameters to see different levels of reserve money left over is another thing that hits more so to our investor clients. The usual, amount of money that we could get by with of money on hand, it's changing a little, but some of this stuff too, I'm not meaning this to be like doom and gloom, because like I said, we've been actually really well positioned to accommodate to shifting the gears a little bit, but without really pulling the plug on a lot of stuff like many other places have. So we have also seen in the process of the COVID as well, where there's a huge volume of people right now that are wanting to attempt to refinance their current mortgage loans. And that's fantastic. We want to help people save money. Don't get me wrong, but there's if you can imagine, what I've been telling everybody, the volume of people that want to save money, obviously who doesn't want to save money, imagine what our industry is currently going through. So like all of 2019, there was around $2 trillion of financing that took place for like mortgage financing, right? Right now, we have identified probably about $5 to $6 trillion of active loan notes that are out there that should be refinancing. And a lot of them are trying to at the same time. And there's only so much capacity and bandwidth in our system to do that, whether you're talking to me or any bank or lender in the country. So it's kind of like right now we have a fire hose of volume that we're trying to push through a garden hose is kind of the what I think you could almost equate it to being. So because of that, it is meaning things are taking longer in some particular settings, but we do put priority over our clients that are purchasing real estate versus refinancing. So we're still able to do your usual, turnkey property investor loans in a pretty short period of time without really delaying it drastically. The appraisers are a little more overwhelmed or bogged down. So, I mean, I'm sure you guys are hearing or seeing that too. But again, we set the table correctly and set the stage in a way that we make sure it's a realistic timeline. But we haven't seen too drastic of a delay on that topic either, within reason. So that's kind of in a short recap of things, kind of what's been happening with regards to the overall market, and again, on a daily basis, we're seeing different changes and experiencing ways that we have to shift on everything that we're working with. But yeah, I don't know what questions.
That's a great recap. Obviously, every time I talk to you, I learn something very detailed, and I have a ton of knowledge. So I really appreciate that. One question I had, you touched on the forbearance, and my understanding is just kind of tracking things in Wisconsin and around the country. These different ideas and notions of giving tenants and renters a break on the rent for whatever amount of time, and then the potential to the counter to that for the homeowners and the landlords to go into forbearance. But they're advertising forbearance as, hey, no credit hit, no blah blah blah. But I think there's a very fine point that maybe you could touch on with, it's still marked on your record, you're in forbearance. So if you then go to potentially invest in more properties or do something along those lines, it may not be a direct hit to your credit, but there is a very tangible effect. So I guess my question to you is, what do you recommend as potentially things become much more favorable nationwide for tenants? What is a real recourse for people like us and our clients?
Yeah, that's a great question that I answer daily throughout the day for people. And yes, with the CARES Act, again, the good and the bad of it is it's real easy to sign up for that forbearance plan. However, the actual, yes, true ramification of it, sure, there's they'll list it as a coded item on their credit trade lines that a forbearance plan was initiated or is currently in place. And then how it is being interpreted right now in the lending community is it's a default. It still is something where you did not pay as promised. So the exact terms of like what the ramification is going to be isn't totally spelled out yet. But from Fannie Mae and Freddie Mac, the government-sponsored entities that most all these loans are backed through from a bonding standpoint, they have so far kind of put some light definitions out there that if you have a forbearance plan in place, they're going to treat it like an automatic 12 months where you will not be able to, have financing issued or executed for you on in most cases. I've heard of some lenders treating it even more severe than that, where some of them are saying, hey, if you did this, we're really worried you're going to do that again. So my recommendation to individuals that are contemplating that, and again, if they're contemplating it because they're saying, hey, look, we have tenants in our property and they're saying they can't pay me, so that's why I want to sign up for this forbearance plan. My recommendation would be to really, talk to an expert advisor like myself, or whomever in our industry, and maybe see if there's a different workaround to do. I know quite a few of my investors that I advise on. What I've been suggesting to them is let's encourage like working out, kind of a promissory note type of arrangement with that tenant. So, maybe you give them a little bit of a break on the rent, like for the next 2 months, maybe you reduce their rent need, of what they have to pay comes down a fraction of it, or if they totally can't pay the rent, but then let's build that into the future rent payments. Don't try to just like flat out like avoid allowing them to make their payment. Like I've had some people saying that, some of the property investors saying, well, I'm just going to let them not make rent payments this month. Well, why would you do that? You would want to still set it up that they're committed to something. They did sign a lease to you. And yes, there are rent, and eviction holidays that, many of the local municipalities and governments have enforced, but that doesn't mean you can't enforce something else on them. They're still living in your investment property, and you want to make up something that is going to be a win-win situation, I think, for everybody. And if you just flat out pull the plug and say, oh, well, you don't have to pay because I'm going to go to my mortgage servicer and agree on a mortgage forbearance. If you again, like you're saying, David, if they want to agree or not agree, but sign up to buy future properties and make their portfolio larger, we don't want this to hinder them, is the key thing.
That's good advice, man. I wrote down a question for you. So if we're gonna, if we're talking to our investors, the ones that are like kind of under contract on a house right now, and they plan on buying it within the next month or two, and they've started talking to you about setting up the loan, like what are kind of some of the things that we should be telling them to, I guess, maybe prepare for, or even guys in the future that are down the line, as far as just like reserves that you probably should have, down payment. I mean, is there any requirement for more of a down payment these days? That kind of stuff.
So the down payment amounts really, the only change, yeah, there has been a slight change, I guess. I don't know that I've had too many investors doing the 10 and the 15% down options, just because even prior to all this, it was really quite steep on like how much higher the interest rates were, and the PMI costs were just like pretty much through the roof. But that option has been removed from the system at the moment. So you do have to pretty much plan still 20-25% down. And regarding the reserves, the underwriting system that Fannie Mae and Freddie Mac use, that all of us banks and lenders essentially are connected into, it's going to still evaluate them from a risk standpoint. So I would say, as kind of a worst case precautionary measure, that they're prepared that they could have up to like 6 months of reserves, could be like a worst case. The reserve definition, though, just so this isn't like interpreted the wrong way, by the way, does not mean it needs to be liquid cash in a bank account. They will honor and accept, in many cases, 401k balances or other assets, 403b assets, and then they use a percentage of it, is how that is worked out. So, yeah, there's some changes happening there, but again, it's not drastic, thankfully.
And that's 6 months of your PITI payment, correct?
Correct. Yeah. So they're going to look at on that property and then other properties that the person owns too. Oh. So it can, as we're building bigger portfolios for some of our investors, it is something we have to kind of address. And again, I'm saying this as that's a worst case scenario. Sure. We still have plenty of approvals that we're working on. If the rest of the profile from a risk standpoint is not real risky, in some cases it's only calling for like 2 months of reserves. So I don't want to have people misunderstand and
Yeah,
think
yeah,
like,
yeah.
oh, I don't want to buy it. I can't buy a property because I don't have 6 months worth of
Yeah.
reserve. There's
Right.
still things we can do about that.
Right. So, and obviously, credit score is a huge play into that. And then for a lot of our investors, they're active duty military, right? And so that
Yep.
that paycheck, the W-2 income, the first and the 15th every month, I'm assuming helps tremendously, right?
Oh yeah. We, as you guys know, we always enjoy helping your investor clients, and many of them, are active duty military. So that part of it doesn't become as much of a cumbersome or concerning topic.
Yeah.
But yeah, this the overall analysis that we use to determine things, again, we'd really highly recommend, like talking with us early on is always very key to just make sure we're, laying everything out correctly. The other strategy that we will use sometimes when people are short on funds for reserves, and I have this one property investor client of mine now. Over the last, I've been helping him probably maybe like 5-6 years now. But when I first was helping this particular individual, he had one investment property. Now he has like probably about 15, I think it is, ranging from single family duplex, 4 families. We just got him a 12 unit property. But at one point, he was running into a problem on one of the properties. He didn't come to me right away. He found out it was the wrong thing he did, but he went to a different, like, larger big box, traditional lender, and they told him, they were like, you can't buy. He wanted to buy 2 duplexes at the same time, and the issue that they were running into was the guy didn't have enough money in reserves. And I looked it over, and as it turned out, the guy had like a paid off duplex. There was another property hanging out there, free and clear, but it didn't count for reserves. When the asset is trapped in the equity, that can't be counted for reserves. So the fix on that one for that individual or that investor was, we did a cash out refinance for like $100,000 on this property that was worth like 300,000, and we fixed the problem pretty much overnight. And the guy was able to execute the 2 additional duplexes that he wanted to buy. So my point, I guess, I'm making with that is, if somebody thinks that they're tight on reserves, that's where we find creative solutions. Like we might put together some kind of loan instrument or note to pull some money out somewhere else and make it workable in many cases.
You do people. Like cross collateralized loans?
No, so we directly don't do too much cross collateralization. That I do with some of my commercial lending referral network that I have. But even that, we can talk about that just briefly too. But yeah, in the case of like reserves, though, sometimes the cash out piece of it is a big thing. Now, one of the other areas that also has been changed up a bit, though, in the last few weeks because of the forbearance and the liquidity concerns, are cash out refinances. So cash out refinances and the whole spectrum of different loan programs are viewed to be a little bit more riskier. So again, various lenders have discontinued doing them or have really raised the bar on it. But that would be something too where, again, we haven't changed up things drastically on it, but many times if we figure that cash out refinance as part of the overall mission or loan strategy, it can really be a pivotal piece. The commercial lending topic is definitely something that landscape has changed a lot in the last 45 days. So we, even within my own portfolio of loan options, one of our mainstream, like, national scale commercial lending outlets, they currently have halted operations. So that one really good resource that many of us used is off of the table at the moment. But we do connect a lot with local community commercial lending outlets on various things. They are experiencing a huge amount of turbulent times right now in the commercial lending world, just because, again, if we look at that whole chain of what happens here, you have tenant not paying, whether that's an individual or if it's a, commercial property like a business, so you have that tenant that maybe isn't receiving income. The tenant maybe is a business, like I said, and then now that business isn't paying the person that owns the property, but that owner might have taken out a commercial loan with that community bank or that, maybe a national commercial lender. So that's where the buck right now is kind of stopping, and the shortfall is happening is in many cases at the commercial lending institution. So many of them are trying to scramble to see if the individual that took out that commercial loan can qualify for any kind of restructuring or any kind of help and things of that nature. So they're probably focused a lot more on that at the current time with most commercial lending institutions. So it is a little different, or more a lot different than normal when it comes to executing commercial loan notes because of what's currently going on. And some are changing their appetite towards what kind of commercial lending they're willing to approve at the current time. Again, I think a lot of that kind of stuff hopefully won't be a real extended shortfall that we're going to run into. That hopefully it'll be maybe just a 2 or 3 month thing, and then we'll get some that'll come back to having an appetite for that again, hopefully. So yeah.
Yeah, that's definitely our hope. Some of the deals that we're looking at right now too. So, but I think you really highlighted an important point too, is folks should definitely be reaching out and getting that. There is no one size fits all, especially in these kind of turbulent times. Folks should be don't make any assumptions what you might qualify for or what you can get. It's 100% individual basis. So we recommend all our listeners and all our clients reach out to Mark David, talk about those specifics, those one-offs, and find creative solutions to make those deals happen. And also just know that there are ways, around through to get deals done. And you're currently working with a couple of our clients right now that you guys are getting creative to make things happen because, one doesn't necessarily have a W-2 anymore, is a 1099 guy, and another one has, multiple properties. I mean, there are a number of different things that come up, but yet we're still closing the deals. And so I think that's a great point that you made. Talk to somebody, get that mentorship, get that guidance. Mark is a phenomenal person for that information too. So, we obviously could, there's so many topics we could jump into, and it's, what's incredible to me is that you're so well-versed in all of them. And then hopefully we get credit for being smart for partnering with someone like you.
Oh yeah, for sure. But yeah, definitely. Yeah. I always welcome, questions that people have, and we, again, really enjoy helping your investors in regards to the mission that you guys have with them and changing lives. I think is always such a big thing that we always feel a special part in that, whether it's, changing the lives of the particular tenant that lives in that property, and then the investor, of course, too, that bought the property for that tenant, to obviously change their lives too. So I think it's such a neat role that we can play in these communities, whether it's that Main Street community that property is located in, but also wherever that investor, whatever walk of life they come from as well. So we always do enjoy helping everybody out for sure.
Good stuff, man. Hey, well, I don't want to keep this too long. I know you're busy, but one thing that just kind of popped into my mind, and you kind of briefly hit it, is just the appraisal process. Have you seen any big changes with appraisals in general? Like I think recently we had someone say that they just did like a drive-by appraisal and they didn't even go into the house. Like has that changed anything that you've seen so far?
Yeah, so there have been some changes on that. Again, kind of like David mentioned, a lot of this is individual by individual, particular case basis. The investment property appraisal requirements once in a while can possibly allow for a drive-by. However, I would say probably that's a little more rare that that's going to definitely take place or not, just because of the different risk factors that are involved with it. But yeah, we are seeing some modifications, more so on the COVID side of it, where it's like the appraisers in some cases are not wanting to or don't feel comfortable walking through a property that's currently occupied by a family to avoid putting themselves in danger or the family that's living there. So yeah, we run into that for that reason. I mean, as far as the extra requirements of what they're looking for in the appraisal, though, that part hasn't really changed a whole lot. Again, like I was saying earlier, we have some delays in the appraiser taking a little bit longer than normally, but again, speaking from like our appraisal process, we still put a pretty high focus and emphasis on prioritizing the purchase transaction. So we have a really nice way of incentivizing that appraiser to say, hey, we want to put a rush on it and get that appraisal back in like 3-4 days. We still have access to that type of thing, whereas other places don't have that connection. So
Yeah.
it can be a big deal.
Is there anything from our end that, like, do we need to start communicating to you earlier to get stuff scheduled? I mean,
yeah, it's always nice to know that the property's ready. but yeah, it really, yeah, that part of it, I think we had a couple different ones this week that came back, and the appraisal management company tried to reach out, whether it's to you guys or to Robin, and then they get the feedback that it's not ready yet. Well, again, we would rather the property be ready than have them go out to the property, see that the kitchen cabinets are not in yet, and then they end up having a extra trip charge or something that somebody's got to
gotcha.
deal with. So
right.
you want to. So yeah, I mean, being efficient on that is more efficient to just have them go out when it's totally done is always the important thing there.
Yeah, that makes sense.
Cool. Yeah.
It's been awesome, man. I appreciate the
Yeah.
education. That's always good to get an update. And Dave, do you have anything else? Any other thoughts?
No, thanks, Mark. Really appreciate it. And we'll continue to send our folks your way. And I think that, one of the biggest reasons we keep pushing, besides awesome service and everything you guys do, is our folks leave with an education. So they get more than they bargained for, and really appreciate that.
Yeah, no problem. Yeah. We always make sure, we get them in the right direction according to what their portfolio objectives are. There's some, as you guys know too, like there's some people where it's like they just want to own 2 properties, that's it. And then there's other, they're on a mission to own 20. And we help them build it, whether it's 1 or 2 or 20 or 50, or whether it's 1 million, 2 million, or my biggest client, he has about now $50 million in properties. So we help them all, big or small. So
Dude, you've been holding out on me, Stu. What's up, man?
Mark, you're supposed to come on, man.
Man, 50 million.
Keep that between you and me. That's a you and me thing.
Yeah, that's right. Cool.
Awesome, man. Well, I really appreciate it. We'll if that's okay with you, we'll send this out to our investors and
yeah, for sure.
just keep them educated. I'm gonna stop recording. Thank you, Dad.